Hi family, welcome back to the channel. Today, let's dive into how an IUL works with a quick story of how it changed this family's life. I want to share a story about one of my clients, Jared. When Jared came to me, he was 37 years old, a counselor, husband, father of two. He wasn't looking to get rich overnight. He was just trying to do something smart for his family, something that would protect them and give them more than just a death benefit, right? He said to me, I don't just want insurance. I want something that helps me while I'm still alive. And that conversation led us to a solution that changed his entire financial outlook. This was an index universal life insurance policy, or known as an IUL. Jared mentioned that he had heard of an IUL before, but didn't really know or have all the details about it. I'm sure telling his story, with his permission, of course, will enlighten you as well. So stay tuned. So, what is an IUL? Index Universal Life Insurance Policy. An IUL is a type of permanent life insurance that covers you for your entire life. It includes a cash component that grows over time. But here's where this policy is different from traditional policies, just like a whole life or term policy. With an IUL, your cash value growth is tied to a stock market index like the S&P 500. So when the market goes up, your policy earns interest based on that performance. But if the market goes down, you don't lose any money. The insurance company guarantees a 0 or even sometimes a 1% floor. So even in a market crash, your value will not drop. So let's talk about it. When Jared started his IUL, we kept it simple, manageable, around $300 a month. Here's what happened to each premium he paid. A portion covered the cost of insurance. Another portion went toward policy fees and administrative costs. There's always the cost of doing business, right? It's fair. The rest went into his cash value account. Here's the key. That cash value account didn't grow based on interest rates like just a regular savings account at your bank. It grew based on an index performance with the market. So if the S&P 500 had a good year, his policy might credit him with 8% or 9% interest on his cash value. The S&P 500 is used as an example here because most people are familiar with it. However, insurance companies have additional index strategies that, if set up, can outperform, what's familiar, the S&P 500. So we can always look at other methods to help grow your cash even faster and receive more interest, right? And this is very important, insurance companies usually set a cap on how much you can actually earn. Jared's policy, for an example, had a cap of 10.5%. So if the market grew 13%, he only would receive that 10.5%. It's the trade-off for having that downside protection and not losing any money in the event that the market crashes. So now let's be real. This isn't a get-rich-quick process. IULs take time to build momentum. In the first 2 to 3 years, most of your premium is covering the fees and the cost of insurance. But over time, especially after year 5, you start seeing consistent growth in your cash value. Jared stuck with it. He made his monthly contributions, and by year 8, he had enough cash value to borrow. He went with $25,000 tax-free to help cover a tuition gap for his daughter's college. So it definitely provided gains for him to assist with sending his child to college. Now, here is where it gets really powerful. The money he borrowed wasn't taxed because it was a loan against his own cash value. He didn't have to withdraw or liquidate anything. His policy continued to grow, even while he borrowed from it. That's the compounding interest. And when he's ready to retire, Jared plans to supplement his retirement income with tax-free policy loans using the same cash value he's building all these years. So the trick here is you can take money out of the policy and still continue to have the money you withdrew grow, compounding interest as if you never even borrowed it. It's a win. But with IULs, it's not just about growth. It's not just about that cash value. If something happened to Jared today, his family would receive over $500,000 tax-free, a safety net that would allow them to grieve without financial chaos. He told me this policy has become our family's plan B, and honestly, plan A too. That's kind of the peace of mind that you just cannot put a price on. So the death benefit is attached, the cash value is attached. You continue to compound on the money that you've taken out of the policy to use for something else. It's a win. So is an IUL right for you? An IUL isn't for everyone. You have to be consistent, you have to be patient and committed. But if you're looking for something that protects your family, grows your wealth with downside protection, gives you tax-free access, funds in the future, builds a legacy while you're still alive, then this might be worth exploring. So if you need additional details, I'm here to help walk you through it. Book a free consultation with me today. We'll walk through your goals, your budget, and see if an IUL could be the next best step for you, just like we were able to do with Jared. You don't have to be wealthy to build wealth. You just have to start early and build wisely. And that's what we are about here at Asaya Life Insurance Agency. So thank you for watching. Like this video, subscribe, hit the bell, and share it with someone who's really ready to take control of their financial future. It's really simple to have a conversation. IULs are not just policies. They are plans for growth, for freedom, for your family, and to leave protection behind.